Let's dive right into today's explainer, where we're unpacking a fascinating AI investment memo on Sunbelt Rentals Holdings. You probably know them by their ticker, SUNB. They are an absolute giant in the equipment rental space, and they've just recently re-domiciled to the United States, shifting their primary listing right over to the New York Stock Exchange. So what we're going to do today is examine their track record, break down their recent strategic shifts, and really dig into the actual numbers to figure out the true quality of this business today.
And that brings us to the multi-billion-dollar question. Is Sunbelt Rentals actually a buy? It's so incredibly easy to look at a massive national company and just assume that because it's huge, it automatically makes for an exceptional investment. But our goal here is to strip away all that corporate noise and narrative. We're going to put this business through a rigorous, skeptical buy-side framework to see if this giant is a truly exceptional place to park your capital right now, or if it's just a decent business facing some seriously stiff headwinds. To figure out where Sunbelt is heading, we need a super quick look at how they got here. Believe it or not, this behemoth started back in 1984 as a tiny UK operation under the Ashted name. The real game changer, that was 1990, when they finally crossed the pond and entered the US market. Jump to 2006, they gobbled up Nations Rent, which gave them genuine national scale. And that brings us right to 2026, the official US redomiciliation and the dawn of what management is calling the Sunbelt 4.0 era. They basically grew into a North American powerhouse through really deliberate, smart capital deployment. But, as we know, historical success only gets you so far.
Management really likes to pitch this company as a highly diversified platform. But if you take a look at the current revenue mix right here, it tells a slightly different story. See that massive chunk? That's the North American general tool segment. Think of your everyday construction and industrial equipment. It still makes up nearly 60% of their total revenue. Now sure, specialty equipment is growing nicely at about 32%, and the UK segment is lagging way behind at just over 8%. But the main takeaway? Despite all the talk of diversification, that general tool segment is absolutely the massive ballast keeping this whole ship afloat.
When we zoom out to the broader competitive landscape, the numbers are pretty fascinating. As you can see, the North American equipment rental market is incredibly fragmented. You've got United Rentals sitting at the top spot with roughly a 15% share, and Sunbelt is right on their heels at about 11%. Now, fragmentation like this is a total double-edged sword. On one hand, it means there is enormous runway for local market share gains. But on the other, it means the competition is absolutely cutthroat, and the market isn't just standing still while competitors consolidate.
So how exactly does Sunbelt defend that 11% slice of the pie? Well, they don't have what investors typically call a structural moat. We're talking no high switching costs, no patent lock-ins, no unique software that traps a customer into staying. Instead, they operate on an execution moat. Their edge comes entirely from operational hustle. It's all about branch density, making sure the fleet is actually there when a contractor needs it, and having top-tier logistics. That kind of hustle is incredibly powerful, but it's also fragile. Why? Because unlike a tech patent, an execution moat has to be re-earned literally every single day out in the field. And that leads us to a really critical pivot point in our explainer. Look, Sunbelt has undeniably built an impressive footprint over the past few decades. But the absolute most vital question for anyone looking to invest in their current expansion phase is this: are incremental scale and investment still creating superior economics? Because let's be real, simply getting bigger just isn't enough anymore. That new growth has to actually be profitable and efficient. So let's peek under the hood at the current fundamental trends, because this is where the picture gets a bit murky. Yes, top-line revenue recently climbed to a very healthy $8.4 billion over a 9-month stretch. But underneath that, we're seeing some real stress. Net income is actually dropping year over year. Adjusted EBITDA margins are shrinking, and their dollar utilization, which is a crucial metric showing how efficiently they're squeezing money out of their fleet, has actually slipped from 55% down to 54%. The directional changes here are exactly what you need to watch. Revenue is going up, sure, but profitability and efficiency are sliding backward. This breakdown perfectly illustrates exactly where that margin pressure is coming from. It's totally a split picture. The North American specialty segment, killing it. It's boasting an 8% revenue growth rate and a massive 30% return on investment, and that trend is pointing up. But look at North American General Tool. Remember, that's their biggest business by far. It only grew by a measly 1%, and its returns are actually trending downward. Meanwhile, the UK market is just remarkably weak, scraping by with only a 6.5% return. Drilling even deeper into that General Tool segment, we hit a core warning sign that we absolutely cannot brush off. The recent organic growth in the segment, which includes new greenfield branch openings, was basically flat.
just 0.6%. So why is that such a huge red flag? Well, management is heavily pitching this idea of a resilient, multi-engine growth story. But you can't have a reliable multi-engine story if your biggest, most important engine is basically sputtering. It tells us they're leaning way too hard on specialty equipment and massive mega projects to pull the wagon.
Now, hold on. I definitely don't want to paint this as a totally doom and gloom scenario, because Sunbelt does have one undeniable, absolute powerhouse of a strength. Over a recent 9-month period, they generated $1.428 billion in free cash flow. That is real, tangible cash in the bank. Their balance sheet is highly disciplined, their debt leverage is completely under control, and the vast majority of that debt is fixed rate. So this proves that despite the margin squeeze we just talked about, this is definitely not some fragile company on the brink. They are a literal cash-generating machine.
But, as always, we need to add some context to that massive cash flow number. A huge reason free cash flow looked so exceptionally stellar recently is simply because they hit the brakes on buying new fleet, bringing that spend down to $1.44 billion. That's a temporary boost, guys, not a permanent new reality. In fact, management has already raised their future capital expenditure guidance back up to somewhere between $2.2 and $2.3 billion. Equipment rental is a brutally capital-intensive business, so free cash flow is always going to be handcuffed to those massive reinvestment needs. Which brings us to how they are actually spending that cash, their capital allocation reality. The good part? They're keeping a very disciplined 1.6 times net leverage. But look at where the cash went recently. They dropped over $1 billion on stock buybacks. Now, buybacks aren't inherently bad, of course, but doing them when your profit margins are visibly shrinking and when your whole UK segment is doing poorly enough to need a major operational restructuring, that definitely raises an eyebrow. As an investor, you really have to wonder if that $1 billion could have been put to much better use.
There's also a bit of a structural quirk we're dealing with right now when it comes to transparency. Because Sunbelt just recently moved its home base from the UK to the US, their public reporting is kind of in a messy transitional phase. Right now, investors just don't have the standard standalone US 10K or the proxy disclosures that usually lay out executive pay and incentives in crystal clear detail. Now, this doesn't mean management is hiding anything under the mattress, but it does mean that for the moment, we can't underwrite their corporate governance quite as perfectly as we'd like.
So, bringing all these data points together from the memo, what's the final verdict? Well, Sunbelt is a good business, but it is not a great business that clearly clears an exceptional long-term investment bar today. The management team is highly capable, no doubt about it, and they've earned their respect. But the current fundamentals, specifically those shrinking margins and the totally flat growth in their absolute core segment, just do not justify handing them a premium of trust right now with your fresh capital.
So if you're an investor sitting on the sidelines, what exactly needs to happen to shift this from a wait and see to a screaming buy? The memo lays out a pretty clear 4-point checklist. First off, we need to see a sustained margin recovery that isn't just propped up by temporary macroeconomic tailwinds. Second, they have to prove that their logistics network actually creates real financial leverage. Third, the returns in that giant general tool segment absolutely have to stabilize. And finally, they need to show us a credible, realistic path for turning around that struggling UK business. And that leaves us with one final provocative question to chew on. As Sunbelt charges headfirst into this highly publicized Sunbelt 4.0 era, is this new strategy going to be the engine that finally restores those exceptional margins and proves their massive scale is actually a compounding advantage? Or is it just going to turn into a much heavier, more complex machine that they have to drag uphill in a slowing market? That is the absolute core tension of this investment, and it's exactly what you need to be watching out for in their upcoming earnings reports. Thanks so much for joining this explainer, and remember, always keep your eyes on the data.